I want to talk about now your fund structure. Your fund it's somewhat unique among opportunity zone funds in that it is structured as a REIT. And I think there's only a handful of funds that are doing what you're doing. Can you explain how you were able to do that? Maybe you can go into some of the geekier parts of how the fund is actually structured, and and also describe the benefits that a REIT structure offers.
Sure, always happy to geek out on opportunity zones. I'm a former attorney, so um, getting down into the nitty gritty of how the laws work is sort of one of my pastimes. But we decided to go with a REIT structure for sort of one particular reason. I think a lot of, or at least the few competitors that we have that are in the REIT structure really are pursuing it um, to put a significant amount of the onus of managing the tax situation on the investors, and not in a bad way, but just essentially letting an investor, through quarterly revaluations and cash in and cash out, sort of choosing their own timing of their opportunity zone tax benefit, which is a perfectly good strategy and it makes a lot of sense. We actually approached it for a different way. We've been investing in opportunity zones in our Link Apartments brand, actually going back to 2012. Our first Link Apartments project that was delivered in 2012 is in an opportunity zone. So we wanted to make sure that we were able to operate sort of in a consistent way across our portfolio, opportunity zone or not. And what the REIT structure allows you to do actually is it frees up some flexibility in terms of selling property. A lot of press around opportunity zone investing sort of conflates the 10-year hold period for an investor with a 10-year hold period on a property. And I think that's primarily because most opportunity zone funds are structured as partnerships, or LLCs, they're taxed as partnerships. And so when you sell a property in that structure, it passes through. And if it's before the 10 years, obviously an investor wouldn't get the benefit. But if you actually read the opportunity zone legislation, the 10-year period is based on an investor's interest in the fund itself. And so what a REIT structure allows you to do is actually utilize internal taxable sales in a way that a partnership fund can't do. So a partnership can execute a 1031, so can a REIT. Anyone who's investing in real estate will understand that. But REITs actually can make taxable sales. And they have two options when they do so. First is to pass through a capital gain dividend that looks very similar to a partnership sale, and actually is the ultimate mechanism. There's a special capital gain dividend after the 10 years, after the 10-year period, that allows for the back-end liquidation with the tax benefit. But a REIT can actually also pay tax internally rather than passing through a capital gain dividend that is taxed to the investors. And when it does that, it can retain the capital that it receives from the sale and reinvest. And unlike a 1031, that investment can be split. So as long as it's reinvested in opportunities on property under the QOZ program, it gives a lot more flexibility. It can be split over multiple projects, a new project and an existing project, paying down debt, things like that. So it gives us a lot of flexibility. The other thing that we found, though, after we sort of made this decision, is a lot of our investors really like it because, at least in our experience, and we are primarily raising capital from the RIA networks and wealth managers and people and individual investors like that, is that a lot of those investors in opportunity zones, don't necessarily have a diversified real estate portfolio where they're used to getting, a complicated K-1 with multiple state tax filings. And so a REIT actually provides investors with a 1099 rather than those sort of more complicated tax liabilities on the partnership end. That for an investor who doesn't have the real estate experience, maybe they're coming out of, their own small business that they've had a realization on, or, maybe their investment advisor, bought them some low basis Amazon stock back in 2005, and they're having a great run in it, and they're diversifying. It gives a lot more sort of a tax simplicity experience for our investors. There are certainly trade-offs there. Obviously, you're not passing through depreciation and things like that. But we found that can actually be really attractive, especially for the investors that we're targeting in our fund.
Got it. That makes sense. And so is it just set up at the QOF level as a C corp instead of as an S corp or an LLC partnership? Is that basically what you've done there, or is it more complicated than that?
Well, it's an LLC taxed as that elects to be a REIT. So it's an LLC with shares essentially.
Got it.
It's not a C corp. REITs don't need to be C corps; they can be LLCs. It actually also gives us some interesting flexibility because um, a traditional, and this will get even more geeky, is a traditional REIT is often set up with an operating partnership. That operating partnership can be a or is our opportunity zone business that we're investing in. So through an opportunity zone business, allowing us to access the 31-month working capital allowance and things like that gives us the time frame that we need. But also because it's an operating partnership, anything that we wholly own under that operating partnership is actually tested at the 70% level rather than at the 90% level for your sort of operative opportunity zone test. So it actually gives some portfolio flexibility as well. Not one that we've utilized too much because we have, at Grow Properties, we have our traditional funds that are also in the market that are investing in non-opportunity zone locations. But the structure is actually interesting because you could theoretically, invest 30% of your capital in non-QOZ locations through this structure and retain your opportunity zone sort of status, which is interesting.